Good morning. My name is Madison, and I will be your conference operator today. At this time, I would like to welcome everyone to the Akumin investor presentation. All lines have been placed on mute to prevent any background noise. After the speaker's remarks, there will be a question and answer session. If you would like to ask a question during this time, simply press star, then the number 1 on your telephone keypad. If you would like to withdraw your question, please press star, then the number 2. Mr. Cameron, you may now begin your conference.
Thank you. Good morning, everyone, and thank you for joining us for today's investor presentation. My name is Matt Cameron. I'm the Chief Legal Officer and Corporate Secretary of Akumin. Joining me on the call today are Riad Zine, our Chairman and Co-CEO, Rhonda Longmore-Grund, our President and Co-CEO, and Bill Larkin, our Chief Financial Officer. Well, you can view our presentation on the screen. A copy of the presentation is also available on the investor section of our website at akumin.com and in our public disclosure at sec.gov or sedar.com. At the end of our prepared remarks today, we will have an opportunity for questions from industry analysts. Before we begin, let me remind you that certain matters discussed in today's conference call or answers that may be given to questions asked could constitute forward-looking statements or forward-looking information that are subject to risks and uncertainties relating to Akumin's future financial and business performance. Actual results could differ materially from those anticipated in these statements. You should not place undue reliance on these statements, particularly on future financial performance. The risk factors that may affect results and these forward-looking statements are detailed in Akumin's periodic results and public disclosure. These documents can be accessed under our public disclosure. Akumin is under no obligation to update any forward-looking statements discussed today, and investors are cautioned not to place undue reliance on them. We may also refer to certain non-GAAP measures during this conference call, such as EBITDA, adjusted EBITDA margin, and free cash flow. Our definitions of these terms are included in the public disclosure, or if not there, are in the presentation itself. Our use of these non-GAAP measures is intended to complement GAAP measures by providing additional information and further understanding of results of our operations. Please see the disclaimer on slide 2 of our presentation for further information. With that, I'll pass things over to Riad Zine.
Thanks, Matt. As Matt mentioned in his introduction, my name is Riad Zine, and I'm the Chairman and Co-CEO of Akumin. I'm very happy today to be able to speak to everyone. It has been an eventful 6 months since our last conference call. During that time, we announced the acquisition of Alliance Healthcare Services for $820 million, completed the closing of this acquisition on September 1st, and successfully closed on all related financing transactions to fund the acquisition. This is another opportunity to thank our investor base across all sources of equity and debt capital for all their support in completing this transformative acquisition. It's an exciting time ahead for Akumin. The acquisition of Alliance has transformed the company, bringing together 2 powerful platforms and 2 great teams. I would like to thank the full team, including our advisors, for all of their hard work throughout the acquisition process. And I'm very pleased to have Rhonda and Bill with me here today as part of the senior leadership team of the combined company. I would also like to welcome all of the Alliance team members to the Akumin family. We are very excited about the journey ahead, and we are thrilled to have you with us. As you can see in slide 4, the combination of Akumin and Alliance has created a powerful platform in radiology and oncology with deep expertise in outpatient service delivery. Together, we are one of the largest providers of radiology services and oncology therapies in the country, with a presence in 46 states. Together, we also serve over 1,000 hospital health systems as partners and customers, which is an important component of our growth strategy given the healthcare industry trends towards outpatient. The new Akumin platform has significant scale, combined trailing 12 months revenues over $730 million in our radiology and oncology business. This is an important differentiator for Akumin. As you know, scale is becoming a critical requirement for long-term success in any industry, something that Rhonda will elaborate on shortly. Now I will turn the presentation over to Rhonda.
Good morning, and thank you, Riyadh. As Matt mentioned, my name is Rhonda Longmore-Grund, and I am the President and Co-CEO of Akumin. On behalf of myself and all of the Alliance team members, I'd like to take this opportunity to say how happy we are to be joining the Akumin team. I'd also like to thank all of those that were integral to the effort to bring these two great companies together, including all of the Alliance and Akumin team members, our key stakeholders, partners, and advisors. We too are excited about the opportunity ahead for the combined company. And as Riyadh mentioned, this transaction is indeed transformational, not just for our company, but for the industry. We've created a truly unique combination of expertise and competencies in outpatient service delivery with deep, diverse, and long-standing customer and partner relationships with hospitals, payers, and referring physicians, all key stakeholders in the delivery of efficient and high-quality patient care. Slide 5 highlights some of the notable hospital system relationships under Akumin today. As you can see, we serve over 1,000 hospitals, health systems, and providers in our radiology and oncology network, including 25 of the top hospitals across the nation. We operate nationwide in all but 4 states and provide our services through exclusive long-term contracts. Not only do these relationships provide Akumin with predictable continuity of cash flow, they are also a key area of growth for the company, as we'll discuss in more detail later in the presentation. Slide 6 has a lot of information in it, but really it captures some of the key differentiators of the Akumin platform and the value proposition for our customers, including hospitals, payers, and referring physicians for the delivery of patient care. Akumin's suite of assets, including mobile and fixed-site radiology locations, as well as fixed-site and interim oncology locations, enables us to deliver customized solutions to virtually any customer in any geography. We're able to evaluate the needs of any community and design a solution set that is uniquely tailored to that community's radiology and oncology outpatient needs. As you can see from this chart, Akumin already has a sizable fixed-site presence with 239 locations, 35 of which are dedicated to oncology. Given current market dynamics, we see a significant opportunity to grow our fixed-site volume as well as footprint in response to hospital demand, with both on-campus and off-campus sites, particularly as hospitals' need outpatient solution accelerates. In particular, we are already in discussions with several potential health systems to leverage our existing fixed-site footprint to accelerate their outpatient strategy for radiology services. This should bring incremental volume to existing facilities. And in addition, we have a strong pipeline of potential de novo as well as service expansion opportunities in cancer care with both new and existing partners. On page 7, you can see Akumin is clearly well positioned to benefit from the ongoing shift to outpatient service delivery. Over 95% of our revenue is derived from outpatient procedures. We have a very balanced revenue mix between third-party payers for outpatient services in hospitals, with no one customer representing more than 4% of our total revenues. Where we are billing hospitals directly, nearly all of the related revenue is for outpatient services, as we are clearly a leader in partnering with hospitals in this arena. We now can leverage our more extensive suite of services and fixed-site platform to expand with existing and new customers and partners searching for outpatient solutions. Slide 8 clearly illustrates that the Akumin platform offers a diverse suite of services. It is focused on areas of high growth and high value add. As you will see when Bill walks through the financials, Oncology is a high margin service line, and we see a lot of opportunity here as hospitals are increasingly seeking outpatient alternatives in this area. MRI and PET-CT are key drivers and together comprise over 80% of our radiology revenues. To elaborate on our radiology capabilities, you can see from slide 9 that Akumin is now the second largest radiology company in the country with over 2 million patient encounters per year on a pro forma basis. In particular, we focus on advanced technologies including MRI and PET-CT that are essential in the diagnosis and effective treatment of many of the most prevalent and challenging diseases and injuries. This includes many types of surgery and cancer care. While PET-CT represents approximately 6% of procedure volume, you'll recall from the previous slide that it accounts for approximately 23% of radiology procedure revenue, which is indicative of its high value. We are a national leader in bringing emerging PET radiopharmaceuticals to the market, including new applications for metastatic cancer, as well as neuro and cardiovascular conditions. As mentioned previously, Akumin is a leader in providing outpatient oncology services in a large and growing high-margin segment of healthcare. Over 2/3 of cancer care patients receive radiation therapy as part of their treatment plan. Clinical value and innovation in radiation therapy has solidified its role in the oncology treatment toolbox. We offer a full continuum of services and solutions to hospital partners and providers in this clinically sophisticated and critical service line. As a key hospital partner, Akumin delivers these services through 22 joint ventures with 35 locations. Given the critical nature of these services, we've seen a strong rebound in demand to pre-COVID levels. We treat approximately 10,000 patients a year in some of the most complex areas of cancer. As you'll see on page 20, we continue to see strong same-store patient start growth. And patient starts represents the volume of patients that start a radiation therapy program in our oncology centers. Hospitals and health systems have continued to migrate to outpatient settings. This is due to patient preference, site-neutral reimbursement, and downstream revenue potential. Akumin is very well positioned to capitalize on this trend as a preferred partner to hospitals for outpatient service delivery. We have decades of experience, outpatient expertise, national presence, and a full suite of solutions clearly which sets Akumin apart. This is why we presently serve over 1,000 hospitals, health systems, and partners nationwide. We expect to continue to benefit from these trends as the needs of our hospital customers grow and accelerate in the outpatient space. Radiology volume growth is driven by a number of factors, including population demographics, disease prevalence, increasing accessibility of radiology services to consumers, and new applications for radiology, including screening. There is increasing demand for this volume growth to be delivered in an outpatient setting. Purchasers, particularly large payers, are driving the shift as they seek to reduce healthcare delivery costs through site-neutral payment policies. Hospitals clearly recognize the need to provide outpatient options to their customers and patients to recapture revenue from the independents, and patients prefer convenient location and shorter wait times at outpatient sites. Deployment of technological advancements in the pursuit of efficient service delivery is better suited to the outpatient versus the hospital site. The need for cancer care continues to increase, driven by high growth of cancer incidence in the U.S., and this trend is expected to continue for the foreseeable future. COVID has further increased this demand as the deficits from missed screenings are addressed. Given the significant growth expected in the need for cancer care, hospitals are in the need of cost-effective solutions which favor outpatient service delivery. Radiology and radiation oncology are increasingly being utilized as complementary tools in the diagnosis and treatment of cancer. And as I said before, the innovation and the clinical value have firmly placed radiation therapy as a lasting and important tool to fight cancer. We are experts in delivering this complex service with a highly trained clinical team and with clinical quality as a focus. This is critical to value-based care models and to creating efficiencies in cancer care overall in the U.S. As you can see here on slide 14, both the radiology and oncology markets are extremely large and essential to healthcare delivery. However, a number of industry trends are increasingly require solution providers with scale to serve the needs of all of the stakeholders. Small platforms are facing challenges to growth as the diversity and complexity of stakeholder requirements increase. Technological and regulatory pressures favor larger platforms such as Akumin that bring scale, clinical sophistication, and comprehensive solutions to deliver high-quality patient care in a cost-effective, value-based environment. At this time, I would like to pass it back to Riyadh, who will touch on our growth strategy going forward. And Riyadh, I'll hand it back to you.
Thank you, Rhonda. The new Akumin platform is uniquely positioned for growth and has numerous drivers for growth. Organic growth through same-store sales is an obvious driver as we leverage our expertise and customer relationships of the combined entity to grow revenues from the existing asset base. There are also opportunities to expand margin as we realize cost savings through integration of the two companies. The expanded solution set of the new platform enables us to expand our hospital relationships and build density in multiple geographies, which we will prioritize based on a number of factors, including partnership opportunities, patient demographics, and referral sources. In oncology, we will continue to leverage our experience and hospital relationships to form new partnerships for outpatient delivery of radiation therapy. Beyond these areas of growth, we see many opportunities to create a highly differentiated service platform that will transform the environment and enhance the value proposition for all of our customers. Moving to slide 16. At Akumin, our culture is one of innovation and standardization of processes and consistency in service delivery for all participants, including hospitals, payers, referring physicians, and patients. As you know, standardization is essential to creating a scalable service delivery platform, particularly in the areas of patient journey and the clinical workflow. Akumin has partnered with leading-edge technology providers to develop robust customer service and an operating environment that will enhance patient engagement and streamline processes. Such scalable technology-driven platform will also enable the deployment of advanced data analytics and business intelligence, which in turn will lead to continuous improvements of the platform. As we have previously discussed, we see many opportunities to capitalize on the synergy potential of the combined enterprise. As indicated earlier, we have identified approximately $23 million that we are confident we can be realized over time, specifically through the integration of back office and corporate functions, consolidation of purchasing power, and development of a new consolidated equipment maintenance service model. Longer term, there are numerous opportunities, including some of the technological deployment initiatives discussed earlier, which will result in further cost savings through process standardization. Now I will turn over the presentation to Bill to lead us through the financial slides.
Thank you, Riyadh, and good morning, everyone. As Matt mentioned in his introduction, I'm Bill Larkin. I'm the CFO of Akumin. I was formerly the CFO of Alliance. As you know, we recently completed a review of certain accounting practices related to historic credit loss provisioning and repair and maintenance expense. The result of these reviews was the restatement of Akumin's 2020 and 2019 fiscal years in Q1 21. Those restated financial statements were filed and released on November 15th, 2021, and together with the Q2 2021 financials. And these are available on our company website and in our public disclosure. All the figures that I'll be sharing with you this morning, are based on the updated accounting processes. Also, please note, Akumin previously disclosed procedure activity levels in terms of relative value units, or RVUs. That metric was well suited to capture the procedure volumes of Akumin on a standalone basis, given that it was operating independent sites only. However, our hospital service offering is not measured on an RVU basis. Given the consolidated entity now includes both hospital and independent sites, we track actual scans by modality across the radiology platform. So going forward, we'll be providing MRI, PET-CT, and total radiology procedure volumes, as well as same-store changes. By providing procedure mix, the volumes, and mix together with radiology procedures as a percentage of revenues, as illustrated in the pie chart on slide 8, we believe you should have enough relevant information at your disposal to accurately track our operating and financial performance over time. Here on slide 19, you can see here MRI, PET-CT, and total procedure same-store volume growth in the top charts on a quarterly basis, and total volumes on an annual basis in the bottom charts for comparison purposes. Looking at the charts for both same-store and total volumes, after experiencing significant COVID-related volume decline across the platform in 2020, we've seen consistent same-store volume growth across the radiology platform. Moving on to slide 20, this is an overview of the oncology business volume trends on a pro forma basis. In the oncology segment, as Rhonda mentioned earlier, we track activity level by patient starts, and we also measure revenue per patient start. Radiation therapy is an essential element of cancer care and over 60% of cancer incidents. Therefore, this segment saw a much more muted decline in activity levels during COVID than the radiology segment. It is an essential service that cannot be deferred. Not only has the oncology business recovered from the modest COVID-related declines and returned to pre-COVID levels, this segment has also exhibited consistent same-store growth in recent quarters. Also, we continue to see increases in our revenue per patient start, and this is primarily due to a mix of treatment types across our oncology sites. So moving on to page 21, slide 21, here you can see our consolidated financial performance on an as-reported and pro forma basis. In the upper left-hand chart, the Q3 trailing 12-month consolidated pro forma revenue of $763.3 million includes $31.6 million of revenue from the divestments of our interventional segments and Alliance Oncology of Arizona. Excluding those revenues, the pro forma Q3 TTM revenue was $731.7 million, which is an increase over 2020 on a comparable basis. Similarly, Q3 TTM consolidated pro forma adjusted EBITDA includes $4.1 million of EBITDA contribution from these divested businesses. Now, turning to CapEx as presented in the bottom two charts. The left chart shows maintenance CapEx, which consists of break-fix type maintenance like replacement of generators and AC units, and also includes replacement equipment that is deployed and has reached its end of life with current customers and JV partners. Maintenance CapEx also includes spend at the corporate level, which is primarily for IT-related investments. So as a general rule, radiology maintenance CapEx is approximately 5% of radiology revenue, while oncology maintenance CapEx is approximately 2%. However, Oncology maintenance CapEx can vary from year to year, based on the needs of our joint ventures. The bottom right chart shows our growth CapEx, which is directly related to new revenue streams. We are acquiring equipment to support new customers and new revenue streams. Growth CapEx expenditures vary from year to year and will vary depending on new business development opportunities. In general, our planned growth CapEx across the consolidated platform assumes a less than 4-year payback on those investments. On slide 22, this is our quarterly and year-to-date financial performance by segment on an as-reported and pro forma basis. Note that the Q3 2021 and Q3 year-to-date pro forma results presented in the bottom two tables assume the Akumin and Alliance businesses were combined for the entire periods while adjusting for the divestiture of Alliance's interventional segment noted earlier, which was completed in the first half of 21. Also, post-acquisition, where we are now reporting two segments. These are our radiology and oncology businesses. This slide illustrates the financial performance of these segments for Q3 21 and year-to-date. In the chart on the bottom right, you'll see for year-to-date 2021, the radiology segment contributed $97.1 million of adjusted EBITDA, with an adjusted EBITDA margin of 21.6%. The oncology segment year-to-date contributed $37.5 million in adjusted EBITDA, with an adjusted EBITDA margin of 33.8%. So year-to-date pro forma consolidated adjusted EBITDA margins were 21.1%. In Q3 21, consolidated adjusted EBITDA margins came in at 19.7%. So based on the high end of our 2021 revenue guidance of $428 million, we expect Q4 revenues to be approximately $186 million, with an adjusted EBITDA margin of 17.5%. This reduction in adjusted EBITDA margin of approximately 2.5% relative to the pro forma results is attributed to a number of factors, including higher non-recurring professional fees and other corporate costs. With that, I'll turn it over to Riyadh to continue on with our 2022 guidance. Riyadh?
Thank you, Bill. Slide 24 sets out our expectations for 22. Our first full year as a combined entity. We expect consolidated revenues to be in the range of $760 to $780 million, which is predicated on modest organic growth across the platform. Adjusted EBITDA is expected to be in the range of $155 to $170 million, which is with very modest synergies included in that range. Please note that this adjusted EBITDA doesn't include the full contribution of targeted integration synergies and the full contribution of business development initiatives during the year 2022. On CapEx, we are budgeting $26 million for maintenance CapEx, or approximately 3.5% of revenues, which is consistent with prior years. The $59 million of growth CapEx is primarily geared to new customer acquisition and partner expansion, as well as new service offerings to existing customers. In our experience, our investments in new customers and sites are high return, typically with a 4-year payback on growth capital or less. As mentioned previously, we will be evaluating all of our markets and prioritizing those that, based on our criteria, have the greatest near-term potential for growth. We anticipate that the growth CapEx spend will be roughly balanced throughout the year, with the benefits of this spend to be evident as we exit 2022. Of the total CapEx, we expect the cash outlay to be approximately $10 million, with the balance being financed typically over a 5-year period. On slide 25, you will see how the guidance translates into free cash flow expectations for 2022. Note that the cash interest payment assumes that amounts due on the Stonepeak note would be met through a PIK during 2022, as provided for in the agreement. Capital lease payments are primarily associated with equipment financing. The middle column, the 2022 midpoint free cash flow of approximately $29 million, excludes the impact of expected integration synergies and growth initiatives, which are expected to materialize toward the end of the year. 2022 run rate includes the full contribution of integration synergies and growth initiatives that we expect to have captured as we exit 2022. Note that all of the free cash flow estimates take into account the cash minority interest payments made to our JV partners. Moving to slide 26, we're illustrating our capital structure at the end of Q3, taking into account our recent share price. As you can see, Akumin's secured leverage is 5.3 times adjusted EBITDA. As an organization, we are focused on reducing this leverage over time. Obviously, this is an initial leverage from this increasing our scale and acquiring a transformative company. The primary driver of leverage reduction will come from EBITDA growth initiatives, including synergy capture, technology-driven standardization, and the streamlining of service delivery. As we have discussed, we have an abundance of growth levers in our toolbox, which we expect will meaningfully increase EBITDA and as a result, reducing leverage. Over the longer term, we believe that our secured leverage will decline below 4 times as we continue to only focus on organic growth and new hospital partnerships. Note that as significant shareholders, we are highly incentivized to prudently optimize the capital structure, and we will continue to evaluate options to do so as market conditions permit. The fact that Akumin has already relationships with a very diverse set of capital providers provides significant flexibility as we explore capital structure optimization alternatives in the future. Moving to slide 27. That said, I want to take a minute to acknowledge our partners at Stonepeak, who were integral to the completion of the Alliance acquisition. Many of you might be unfamiliar with Stonepeak, particularly since its investment in Akumin is really its first meaningful foray in the healthcare sector, despite a very long history in several other infrastructure sectors. Stonepeak is a leading alternative investment firm specializing in infrastructure and real assets with approximately $37 billion of assets under management. What has attracted them to this investment is a company of significant scale in a healthcare service with infrastructure like assets. Through its 12-year subordinated notes, equity position, and warrant holdings is well aligned with all shareholders as key beneficiaries of Akumin's future growth. That concludes the prepared remarks portion of the presentation. I hope that it provided an informative window into the new Akumin and the potential of the combined platform going forward. On behalf of Rhonda, Bill, and myself, I would like to take the opportunity to thank all of our employees, radiologists, customers, and partners for all of their efforts in making the quarter another success. We would now ask the operator to start the question and answer period.
All right, thank you so much. Again, that is star one to ask a question. If you find your question has been answered, you may remove yourself from the queue by pressing star two. We'll go ahead and take our first question from Endri Leno with National Bank of Canada.
Good morning. Thank you for taking my questions. I'll ask a couple. I'll start with the synergies first. I was wondering if you can talk a little bit about how much of the synergies, sort of what percentages will be realized in each of the three phases, and how much of those $23 million of synergies you talk about are included in the 2022 guidance. Thank you.
Thank you, Andre, and thank you for your question. The majority of the synergies will be achieved in the phase one and phase two of the synergies, and as I indicated earlier, a very modest synergy number is included in 2022. Obviously, what we have, since we've closed the transaction, we have embarked on the integration process. It's still undergoing, and obviously, this is an amazing opportunity for the company to get it right in multiple aspects of corporate services and shared services. And we're taking our time to assess both companies, but also to define, which is, I believe, much more important, the new operating model going forward. And it's the new operating model that will drive those synergies and efficiencies. So it's really it's a fraction of the 23 million, Andre, that is in the 2022 number. It's not even worth. I think if it was a meaningful number, we would have disclosed that.
Okay, great. Thank you. Sorry, and if I may, a follow up on the synergies. Not necessarily on the 23 million, but you had previously talked about a further 12 million to be realized from Alliance and another $8 million from the acquisitions you did in Florida earlier in 2021. I just wanted to ask, are those still on the table, and are they included in the 2022 guidance? And if they're not, any timelines to achieving those as well? Thanks.
Okay, no problem. Thank you. Yes, obviously, some of the I think your question, the prior acquisitions, the tuck-in acquisition we did from prior to Alliance, yes, those any integration that was completed, those synergies are in the 2022 plan, as we've already executed on any headcount reduction as a result of what we've acquired as tuck-in acquisitions in the year 2021. So those are included, Andre. Any upside from the service delivery, any upside from all the technology investments that we've been doing in Akumin over 2 years, as you know, none of that upside is in the 2022 numbers as well.
Okay, great. Thank you for the color. And my last question is, and I think Bill touched on it a little bit, but it's more related to the implied Q4 21 guidance EBITDA. And I think that there was a bit of talk about higher non-recurring professional fees and other costs as it relates to margin. But I was wondering if you can talk a little bit or expand rather, what is impacting Q4 21 EBITDA, and why are those factors not expected to repeat in 2022?
Sure, I'm happy. We're happy to provide more color of that, Andre, and I will turn it actually over to Bill to answer that question.
Sure, Riyadh. Again, as we look at our Q4 guidance, we are, in the middle of or integrating the two businesses, and we are, incurring additional professional fees, in support of integration, of the businesses. And so as we look at Q4, we are going to see some noise in those results, that we would not expect to be, recurring going forward.
And also, Rhonda, if you have any additional.
Yeah, I would just like to make a comment, as we come out of Q4, certainly this is the first full quarter of the two companies. As we move into 2022 through our guidance, we expect to see every quarter to be better than Q4. So that's, as we're looking through and into our midpoint of guidance for sure, that, we know that there's, as Bill mentioned, a bit of noise in Q4, but we expect to see some modest improvement as some of those costs moderate down.
Okay, thank you. Thanks for the color. And one follow-up, and then I'll get back in the queue. Any labor impact you can talk to about in Q4 that will go forward into 2022? And are you seeing any impact from the new variants on hospitals, well, for the better or for the worse from Q4? That's it.
Yeah,
Thank you.
Thank you, Andre, and I think the short answer to that question, we're not any different than any other industry. We're all facing labor issues. It's counterintuitive in the context of pandemic that it's a very hot market at all levels, and obviously labor market is very tight. I think we're quite fortunate that, again, another benefit of scale. Scale really helps to kind of mitigate those situations. We have factored that into the 2022 plan, Andre, but that's the reality of the market today. So there is some labor cost increase, but actually more than the increase, what is actually something that we've never seen in recent history. There is no labor. We actually, the reason we're focusing more on technology, and we've been focusing on these for a couple of years, because we actually saw these coming. We saw clinical workforce shortage coming. So that is something that we have been working on to address, and we are well positioned to take advantage of the investment and the time we spend to automate clinical workflow, to be able to actually deal with the clinical shortage that we believe will only get worse from here. And again, our scale will only benefit us as it relates to what we haven't seen coming, which is kind of labor shortage at other aspects of the business, whether it's front office or back office. As post the pandemic, we also believe our investment in a technology-driven patient journey will help us over time to mitigate that, and also put us in a position of strength. Because what's really important as we continue to grow with our scale is to remove all the bottlenecks for organic growth. Because from what we see in the market, even without partnerships with hospitals, there is a lot of demand for our services, and we need to get positioned to remove all the bottlenecks at any step of the way, whether it's front desk or clinical workforce or back office.
Great. Thank you very much for coloring. Looking forward to 2022.
All right, we'll go ahead and
Thank
take
you,
our
Andre.
next question from Noel Atkinson with Clarus Securities.
Good morning, folks. Thanks very much for taking our questions today. First off, just on the growth CapEx program for 22, can you talk a bit about what you're expecting for a mix in spending between the oncology and the radiology units? And then just related to that, does your growth CapEx program incorporate opening de novo centers, tuck-in acquisitions, and that sort of thing as well?
Thank you, Noel, and thank you for the question. There were two parts of your question. I'll deal with the second part and ask Bill to deal with the first part. So the second part of your question, we are really focused on organic growth. So the short answer to the second part of your question, we're not factoring in any tuck-in acquisitions, and any de novo are in the context of a new partnership with a hospital or health system. So that's really the focus of the platform. I mean, we built the scale because the organic growth going forward is more than we could handle in terms of growth opportunities. So we're going to focus on that, and we need to get better at executing them as fast as we can. And you've seen the internal rate of return. If you could actually execute on growth capital with less than 4-year payback, and we have plenty of those, why would we do tuck-ins? We will only do tuck-ins if they're going to further enhance the organic growth in the future, but none of those are in the 2022 plan right now. I'll move it over. I'll actually pass it on to Bill to answer the first part of your question.
Sure. As we look at our plan, right now, our total CapEx spend is about 26 maintenance and 59 growth. And, that growth, today, as we look at that plan, is more heavily weighted to the radiology business based on, the landscape of the market and, what we see in terms of opportunities in the pipeline today, as we're looking at our plan. Of course, that can change, throughout the year. But as we sit here today, that is more heavily weighted to the radiology business.
Great. So next, I think I'll just ask the question a little bit differently than the last fellow. Have you seen any of your hospital partners or healthcare partners putting the brakes on non-essential imaging procedures or seeing any slowdown in patient volumes with the recent ramp in COVID cases?
I'd be happy to take that.
Thank you for that question, Noel. I'll get, Rhonda, if you could please take that on.
I know this is Rhonda. Thanks for the question. At this point, it's quite different from last year, where we have not seen any shutdown of essential services, and our volume actually continues to move. Really the hospital landscape, they've learned a lot through the 2020 and early 21 timeframe in terms of how to segregate COVID from non-COVID patients, the safety protocols and infection control that has been implemented. So, we continue to see strong growth, and we continue to see, continued dialogue with the hospitals around new contracting and outsourcing. So that has not, we have not seen any dip in volumes.
Okay, great. And then two quick ones. The first is, what are you expecting for a tax rate in 2022? I see your adjusted EBITDA just flows pretty much to free cash flow, other than the other outlays, without any sort of tax expense in it.
as we sit here today, we're not expecting any, significant, change in our, overall, effective tax rate. As disclosed in our, financial statements, right now, our statutory rate, around about 26.5%. And then, as we bring, the businesses together, we're looking at our overall, tax structure, of the businesses, our tax provision, and then, ultimately, looking at all of our deferreds, which, ultimately would have an impact on what that effective tax rate is. But as right now, I think it's safe to look at, around about that, 26% effective tax rate for now.
Okay, thank you. And then maybe if you could talk a little bit about so new partnerships, new expansion. You're talking about organic growth. So how do you go about achieving new partnerships with hospitals or expanded partnerships with your existing entities that you're working with? And what is the pipeline for that? Like, how active is that opportunity pipeline right now?
Mm-hmm. Well, thank you. I'd be happy to take that question. Certainly, the Akumin team, we have a team of business development folks that work across the radiology and oncology platform, and really they are, working with very robust pipeline of hospitals across the country, up at at the very senior levels, really focused on long-term relationships, whether it be through a joint venture or whether it be through some type of long-term service agreement with those hospitals. So it is a continued area of work. It's an important area of work, and with a very robust and stable pipeline, which, as you look at the future, allows us to continue to retain and expand our relationships, as well as bring new through our growth capital that you see each year. So, but it's a very robust environment. In 2020, the hospitals were a little bit slower because they were dealing with a lot of complexity with COVID, but that has really taken good shape starting 2021 back to pretty robust levels of dialogue.
Yeah, sorry, one more quick follow-up. Are you seeing competition for this, for new opportunities, or is this really just, you're just going out and seeking out new opportunities without any sort of tender activity?
No, there's certainly competition in the market in various segments. I would say that on the radiology side, with respect to mobile contracts, depending on the region that we're operating in, there will be some competitive work. I would say, on the oncology side, most of the dialogue, most of the competition is really just the decision for a hospital and whether or not they're going to take this on themselves, or whether or not they, are ready for a partnership. So it's a little bit different in the oncology versus the radiology side. The oncology side is very, these are long-term joint ventures where we are, working with the hospital on the best structure going forward. You will see more competition, however, in the hospital space, especially in mobile.
Okay, great. Thank you very much.
All right, we'll go ahead and take our next question from Tania Gonsalves with Canaccord Genuity.
Good morning, everyone. Thanks for taking my questions. Following up on one of Noel's questions, so with respect to growth CapEx in the radiology space, I think you previously talked about rolling out men's health in certain of your centers. Is that included in those numbers, and can you talk to what percent it might be?
Thanks, Tania, for joining us, and thank you for the question. That with the Alliance acquisition, and the rest of the focus for the balance of 2021 that has delayed some of the growth plans on that front. And also, not only just delayed it, actually made it more exciting, but you have to look at a different twist now. Because what we have now with Alliance, which we didn't have as just Akumin, now the men's health, and I think you're referring to our partnership on the prostate centers. So we don't have anything in the 2022 plan for that. That would be upside. But I think what changes with Alliance, now the focus for those men's health would be more in partnership with the hospital, because it would make a lot more sense than going at it from an independent perspective. So we're exploring that, and that is actually which is an interesting why we do have both radiology and oncology. So that one is kind of a radiology. It's a crossover between radiology and oncology. So it's almost like a radiology equipment with the thought process and the price point of an oncology practice. So we have, with the Alliance acquisition, not only we have both expertise in house, but we also now have access to relationships with hospital partners that will help us prioritize which will be the first two men's health that we will launch hopefully in 2022, and that will be upside to the current plan.
Perfect, thank you. And then I was wondering if you could provide any color on how the non-controlling interest adjustments would impact your adjusted EBITDA. I noticed there's a bit of a shift in how you're reporting adjusted EBITDA. That NCI line item is no longer being adjusted for. So what is, I guess, the annual difference in 2022 that we should be factoring in?
Yeah, and actually, let me first maybe, before we get to the number, really explain why this shift, because I believe it's really, really important. And it's not a shift for the sake of shifting to another number. It's actually, we put a lot of thought into it, and it's a shift that makes sense. Why does it make sense? What you're looking at as a combined company, we actually have 100% of the revenues, right? We consolidate 100% of everything. So if you have 100% of the revenue, to actually calculate any meaningful margin, you have to look at the 100% of the adjusted EBITDA before minority interest. Because after minority interest, it makes no sense to look at that margin to revenues that are 100%. That's number one. Number two, the leverage will also not make any sense. So the leverage that we have on our balance sheet is also for 100%. Like all the debt that is in the JVs, we don't have the proportionate share of that debt on the balance sheet. 100% of the debt is on our balance sheet. So that's why also to calculate the leverage, you will actually be calculating the wrong leverage if you do it on an adjusted EBITDA after minority interest, because all the debt is on the balance sheet for 100%. So that's the second reason. The third reason, when we talk about capital expenditures, we don't talk about our share of capital expenditure. Those are also 100%. So in that context, these shifts makes a lot more sense, so we could assess the real margin in the business, the real leverage in the business, and the real capital intensity in the business on a consolidated basis. What's the number? I think we put that in our free cash flow calculation for 2022. So those are the distributions we expect to make to minority interest in the year 2022.
Right.
Does that help, Tanya?
Yeah, no, that makes perfect sense. I really appreciate that. And then one last question for me. You talked a little bit about your intentions to bring that leverage profile down over time as you grow the EBITDA line. Aside from EBITDA growth, do you have any plans to, I guess, repay debt earlier than anticipated to take that leverage down quicker, or do you just want to focus on EBITDA growth today?
I think what we will do is we will just focus on EBITDA growth, and then again, this is another benefit to scale. When you have 100 million of revenues, even if you're doing 5% same-store sales, it doesn't do much. But when you're approaching $1 billion, 5% same-store sales, it changes completely your picture, especially when you don't have another corporate overhead and you have, you've seen the margins even fully baked for radiology segments and oncology segments before corporate overhead. They're still very healthy margins, but the contribution of same stores is even, as we've explained in the past, much higher than that because there is more fixed cost component inside each segment. So you have a lot of operating leverage. So that's why, we're not saying we're focusing on what we're focusing on because of, the capital structure we have in place today. And I want to make these clear because I don't think we did it in the presentation. Today, even if we had, with our scale, if our leverage was 3 times, you will not hear a different presentation. We will not be focusing on tuck-in acquisition because the multiples for tuck-in acquisitions today, and I'm sure you've seen some of the deals that were just completed recently, they're approaching 10x and 12x for businesses that don't even have 25 million of EBITDA. So why would we actually invest capital at 12 times multiple when we could invest capital with our scale and have a payback of less than 4 times? So we have already presence in multiple markets. So the strategy is changing not because of capital structure. It's changing because we've got the scale and we have the market presence that we have. So the short answer to your question is, yeah, it's going to be all organic growth. It's not, we don't need to pay back debt to actually come down to that leverage.
All right, that sounds great. Thank you so much, Riad. That's all for me.
Thank
all
you,
right,
Tanya.
we'll go ahead and take our last question from Kyle McPhee with Cormark.
Hi, everyone. Just on the 59 million of growth capex, is this kind of a one-time big opportunity to be investing in organic growth, or is this going to be a sustained spend, beyond your 2022 guidance? And I'm really asking to get a better feel for that forward free cash flow beyond your guidance period, and that kind of informs the need for whether or not you're going to have a sustained use of this pick option on those Stonepeak debt.
I think the growth capital. Oh, sorry, Riad. I was going to say I think the growth capital.
No. Please go ahead.
It's really dependent on the pipeline of opportunity that we see. So if you look at history, you can see fluctuation in the growth capital depending precisely on what we believe is in front of us to execute in the following year. So, as Riad said, our focus is really to utilize, more organic options from a growth perspective that give us a much more efficient payback than, deploying into M&A at this time, unless it was really, some comparable economics.
So it will.
Got it. Okay.
We see a lot of opportunities.
It will vary.
It will depend it will vary in future years. That's what it is for 2022. I think Rhonda said that earlier. The pipeline remains very strong. If we see that we have more to execute on in 2023, then we'll act accordingly. But also remember, Kyle, that there is an upside to synergies, upside to other cost savings that we're working on and operating models of the new combined enterprise. So that's the real focus, and then we'll decide on in 2023 how we're going to deal with growth. What's going to be the right dose of growth capex to focus on, because I think Rhonda also said that earlier in the presentation. We prioritize growth capital. So what we've done in 2022 that's not the exhaustive list. That's the one that we prioritize as the one that will give us the highest contribution from deploying that cap.
Okay, and one quick follow-up.
I was going to say there are no shortage of growth opportunities right now in the hospital landscape, as you know, every hospital is really trying to think through how they accelerate their outpatient model in the environment of value-based care and efficiency, et cetera. So it's a really robust time to be in this type of model going forward.
Got it. Yeah, I guess I was just trying to understand how you're balancing the growth spend versus what is now, you know, significant dilution on the pick option. Just one follow-up on the pick option. How does the share price work? Is it a discount to whatever's prevailing in the market? And can you disclose that discount?
No. It doesn't. There is no dilution from the pick option. We have a 2-year pick option, and if you pay the interest, you pay it at 11%. If you do pick it, you pick it at 13%. So that's the impact.
So the balance of the principal owed on the notes goes up. It's not equity going up.
Yeah, that's the impact, but it's not a share price.
Okay.
Yeah, it's not like you're not paying in shares. You're paying in kind in principal note.
Got it. Okay, that's it for me.
Sorry about that confusion. The agreement works just at a higher rate in PIK versus cash. That's all.
All right. Well, that is all the time we have for questions. Mr. Zan, I'd like to turn the conference back to you for any additional or closing remarks.
Thank you, everyone, for your participations on today's call, and have a great weekend.
This concludes today's call. Thank you all for your participation. You may now disconnect.